The U.S. stock market is today more vulnerable to a major technically driven flash crash than it has been at almost any other time in market history. In today's video, I'm going to explain why it is that the market has become so vulnerable to a flash crash. And in the process, I'm going to let you in on a couple of secrets, or things very few people know about. First, you're going to learn some little-known facts about market structure that are quite shocking. Second, you're going to learn some things about the mechanics of price formation and about the process of price discovery that very few people understand, including market professionals. The information that you're going to learn in this video is going to help you become a better trader and investor. Because in order to understand how a flash crash happens, you really need to have a deep understanding about how prices are formed in the stock market. Before getting into what causes a flash crash, let's review exactly what a flash crash is. For purposes of this video, I'm going to define a flash crash as a major decline of 5% or more on major U.S. equity indices such as the S&P 500 or the Dow Jones Industrial Average that occur during the course of a single trading session. In particular, in this video, I'm going to be focusing on technically driven flash crashes. These are flash crashes that appear to be unrelated to changes in the fundamental economic factors that can impact the value of common stocks. These crashes appear to be related to unusual developments in market structure. And as we go along in this video, I'll be explaining exactly what I mean by market structure. Now let's go over some historical examples of flash crashes. I'm specifically going to go over 3 of them. The flash crash of May of 1962, the flash crash of October of 1987, and the flash crash of May of 2010. Now, as we go through these examples, one thing that I want you to notice, in each case, the flash crash was related to an innovation or an important new development in market structure. For example, on May 28, 1962, the Dow Jones Industrial Average and the S&P 500 fell by almost 6% during the course of just a few hours on a single trading session. Now, this crash was associated with a period of time in which there had been a massive influx of retail investors that were newly participating in the stock market. The technology and the techniques that had been developed until that time simply weren't equipped to handle the massive surge of trading and client flows that occurred on that specific day. And what would otherwise have been a minor down day in the market turned into a crash. On October 19th of 1987, a day known as Black Monday, the Dow Jones Industrial Average and the S&P 500 at one point during the day dropped by as much as 25% in a single trading session. One of the key innovations that affected market structure that contributed greatly to this crash was the massive increase in the use of something that at the time was called portfolio insurance, but which today we simply know as index puts. On May 6 of 2010, at exactly 2:45 p.m., there was a flash crash in which the S&P 500 and the Dow Jones Industrial Average each declined by about 9% in a matter of just a few minutes. A key innovation at this time that greatly impacted market structure and which greatly contributed to this flash crash was the massive surge of investment in exchange-traded funds, or ETFs, by both retail investors and institutional investors. The market systems in place at this time simply weren't able to handle the stresses to market structure that was caused by the massive influx in trading through these particular vehicles. Now today, as I survey developments and innovations impacting market structure, I see the potential for disruptions that are even greater, potentially, than the disruptions that caused the 3 historical examples of flash crashes that I just reviewed. Now, I'm going to review a number of innovations and developments that I believe are setting us up for the possibility of a major flash crash. But all of these developments can actually be encapsulated under a single heading, which is the growth of value-insensitive trading and investing. By value-insensitive trading and investing, I mean trading and investing where the decisions on whether to buy or sell a stock have absolutely nothing to do with the fundamental economic value of the stock. The growth of value-insensitive trading and investing has many different manifestations in the market, but I'm going to divide this into two separate groups. The first group is passively managed funds, or the massive growth in funds under management by funds that are passively managed as opposed to actively managed. Passively managed funds pay absolutely no attention whatsoever to the economic fundamentals of the stocks that are bought and sold. The decisions on whether to buy or sell have nothing to do with fundamental economic value. The second major category is the growth of a number of different short-term trading strategies or techniques, all of which are completely value insensitive. In other words, these techniques pay no attention to what the fundamental economic value of the stocks traded are. In other words, under these strategies and techniques, the decisions to buy and to sell have absolutely nothing to do with the fundamental economic value of the stocks that are traded. Let's review these two categories individually. Let's start with the phenomenon of passively managed funds. There has been an explosion in the assets under management in the U.S. market that are passively managed. In the year 2000, roughly about 10% of funds were passively managed. This grew to about 19% by 2010. And just last year, 2023, was the first year in which passive funds under management surpassed the amount of funds that were under active management. This is pretty profound when you think about it. Over 50% of funds in the U.S. don't care at all about what the fundamental economic value of the stocks and bonds that they trade are. They will buy them or they will sell them based on criteria that have nothing to do with the economic value of those securities. When I'm talking about funds, I'm talking about retail mutual funds, ETFs, pension funds, and institutional funds. Now, to say that over 50% of all funds in the U.S. are managed passively without any regard whatsoever for fundamental economic value, that actually understates the problem very substantially. Because among the roughly 40 some odd percent of funds that are supposedly actively managed, studies have showed that a very large proportion of them are actually what are called or what are known as closet indexers. In other words, funds, actively managed funds that are closet indexers, their holdings are virtually undistinguishable from the holdings of a passively managed fund. In other words, a large proportion of their holdings are simply mirroring the benchmark index and are not taking any active risk. Now, the percentage of actively managed funds that are actually closet indexers varies depending on the study that you look at. The estimates vary between 40% and 80%. Now, I've looked at all these studies, and I actually think that the percentage of actively managed funds that are actually closet indexers is probably somewhere in the neighborhood of 70%. In other words, it's much closer to 80% than the 40%. So if we combine the assets under management that are explicitly passively managed, plus the funds that are supposedly actively managed, but which are actually passively managed, we get a figure that over 80% of all funds under management in the United States are actually passively managed. This is shocking. Now, to say that over 80% of all funds under management in the United States are passively managed, and to relate that to the problems that it causes to market structure, actually understates the problem. Because even among the 20% or so of funds that are truly actively managed, the vast majority of them, by mandate, are obligated to be 100% fully invested in stocks at all times. So what this means is that those actively managed funds are able to sell certain stocks and use the proceeds to buy other stocks. But they can't actually say, hey, you know what? The entire stock market is so overvalued, or there are so many stocks that are overvalued that I'm going to hold a lot of cash in my portfolio because a lot of stocks that I would have in my portfolio, if I were forced to be fully invested at all times, would be overvalued. They can't make that choice. Their mandates obligate them to be fully invested at all times, which means that those active managers actually hold a lot of stocks in their portfolio that they probably think are overvalued and which probably are overvalued. So if we look at the valuation of the U.S. market as a whole and the issue of market structure, what we see is that over 95% of funds in the United States play absolutely no role whatsoever in the regulation of the valuation of the market as a whole. These funds can, to a very small extent, only 20% or so, regulate the valuation, relative valuation between different stocks. But when it comes to the valuation of the market as a whole, market structure is such that over 95% of funds over management couldn't care less whether the market was extremely overvalued or was undervalued. They have no power to influence that decision. In other words, price formation is occurring. Price discovery is occurring with 95% of funds being completely insensitive to economic fundamental value. Now, it doesn't take an economist to realize that if 95% of all funds in the United States are essentially managed passively with respect to the valuation of the overall market, then we shouldn't expect the valuation of the overall market to be efficient. If 95% of funds are trading stocks on criteria other than economic fundamental value, then we really shouldn't expect prices in the market to reflect fundamental economic value. That's just logic. That's common sense. That is almost necessarily the case. That if 95% of funds are basing their decisions on criteria other than economic fundamental value, then the prices that we see reflected in the market will not reflect fundamental economic value. Now, we just looked at the first big group of value-insensitive traders and investors. So let's look at the second major group. That is going to be traders that employ value-insensitive strategies. And that is the vast majority of traders that actually trade in the market. Now, let's briefly look at some of the main categories of these traders. Now, by far, what has become the most influential group of these traders are what we can broadly refer to as algorithmic traders. These are trading strategies that are executed by computers. They're programmed by people, but they're executed by computers, so there's no discretion involved. And all of the strategies that are employed, or the vast majority of strategies employed there, are completely insensitive to fundamental economic value. They base the decisions based on quantitative research. They do research on how prices behave under different circumstances, and based on statistical probability, buy and sell signals are generated. Those buy and sell signals are generated on criteria that are related to technical analysis, that are related to different types of price patterns, that are related to momentum. And momentum particularly is the most important category out of all of these different types of algorithmic trading strategies. Now, I want to focus on momentum strategies specifically because momentum strategies and the explosion in the amount of assets under management that are managed by trading platforms that use these momentum strategies is a development in market structure which has the potential to vastly magnify movements, whether they be to the upside or to the downside. In momentum strategies, the only thing that they're looking at, for example, is if the market is going up. If the market is going up, they buy more. And as soon as the market starts to go down, or the algorithm says that the momentum of the market is broken, they exit their positions. And in fact, a lot of these momentum strategies, they not only sell their long positions, they can actually flip and go short. So at any given point in time, if these momentum-driven strategies happen to be extremely long and the market actually reverses its momentum, these funds will blindly sell whatever they hold. And some of them will even go short right away in a way that pays absolutely no attention whatsoever to fundamental economic value. In other words, one of the trading strategies that employs momentum, they're not going to sit there and say, you know what? The stock market has already fallen by 15% and these stocks look cheap, so I'm not going to sell. No, absolutely not. These are non-discretionary, computer-generated decisions. And if there's been a sell signal that's been triggered, they're going to sell all of the stock in their portfolio up until what the strategy demands in a way that is irrespective of value. Now, the other major innovation and development in terms of market structure that we need to look at closely is options trading. There's been an explosion in option trading, both by institutions and by individual investors. And options trading today essentially dominates the market. There's a higher notional value of options trading than there is in the trading of the underlying securities. And so what that means is that in our current markets, the tail is essentially wagging the dog. In other words, whatever is going to happen in the options markets is going to have a profound effect on the underlying securities. And what's even more shocking about this is that ODTE, which is 0 days to expiration options. These are options that are bought during the day and have to be sold before the end of the day. This actually constitutes the majority of options trading today. So not only does options in general dominate the markets today relative to direct trading of shares, it's 0 days to expiration option trading. In other words, options trading that happens intraday, which now dominates options trading. So the structure of supply and demand in the market has become overwhelmingly short-term oriented and overwhelmingly value insensitive. 0 days to expiration options traders couldn't care less about the fundamental economic value of the stocks or the indices that their options are based on. Therefore, market movements, or I should say, the price that we see reflected in financial markets, which are dominated by options trading, are not going to reflect fundamental economic value. Because if these traders don't care about fundamental economic value, then the prices that are generated by transactions between these option traders or that are driven by these option traders, those prices are not going to reflect that fundamental economic value. Now, I'm going to briefly explain to those of you that don't really understand or may not be sure about how options trading impacts the prices of stocks in the market. I'm just going to give you a very brief explanation. It's not going to explain everything, but it's going to give you a flavor. So when a trader buys an option, there's a market maker on the other side of that trade that is transacting with that options trader. So if I buy a call option on a stock, there's somebody who's selling me that call option. Now, that person needs to hedge their long position. What that means is that if the stock, the underlying stock that my option is based on, rises by too much, the guy who sold me the call could lose a lot of money if that stock rises really high. So what does that guy do, or that person do? they buy the stock, they buy the underlying stock to actually hedge their position that they have against me. So whenever you have a lot of buying of call options, that's also generating underlying demand, a lot of underlying demand to purchase the actual underlying stock, and vice versa. If you get a lot of put buying, a lot of people that are buying puts, then the sellers of those puts are shorting shares. And the further that the stock falls or that the market falls, the more the market makers will be hedging their positions by selling stocks short. So what you can see here very clearly, you don't have to be an expert, is that there's a tendency for options trading to potentially really, really magnify moves in the market that go beyond a certain point. Now, it's actually true that within a certain range, option trading can actually serve to stabilize markets. But once markets get outside of a certain range, options trading can actually serve to really magnify movements. But for purposes of what we're talking about today, what I really want to point out is that all this purchasing of the underlying shares that the market makers are doing have absolutely nothing to do with fundamental economic value. They couldn't care less. They're simply hedging their positions. They're buying stocks not because they think that they're an attractive stock or that it's undervalued. They're buying it simply because they're hedging a position that they have, and the way that they make money is to earn premium based on the options that they sold. But they couldn't care less if that stock has a P of 15, if it has a P of 30, or if it has a P of 157. They don't care. So one of the features of options trading is that it generates a lot of demand and a lot of supply that is completely insensitive to fundamental economic value. Now, that's not just because the traders that buy and sell options are insensitive to fundamental economic value. It's that the market makers are engaged in an activity that is necessarily insensitive to fundamental economic value. And that's the very important thing to understand here. So I've talked to you a lot about traders and investors that are value insensitive. In other words, traders and investors that make decisions to buy and sell stocks on criteria that have nothing to do with fundamental economic value. Now, just how important have these constituencies, these value insensitive constituencies, become in the market? There are various estimates that are made, and I'm going to give you a few statistics. But bottom line is that it is generally agreed that less than 10% of all transactions that are made in the market on a daily basis are being made by the value investors, by stock pickers that actually look at the fundamental economic value of the shares that they're buying and selling. Over 90% of purchases and sales in the market are being made by investors and traders that are completely insensitive to fundamental economic value. And that is the passive investors or the managers of passively managed funds and the closet indexers that I mentioned to you. And it's also these shorter term traders that are employing strategies that are completely value insensitive. Between the two of them and others, we're talking about over 90% of the market is dominated by value insensitive trading and investing. Now, if over 90% of trading on a daily basis is dominated by traders and investors that are value insensitive, we have no reason to expect that prices that emerge from the market will reflect fundamental economic value. In other words, if 90% of the people that are trading don't care about fundamental economic value, we have no reason to suspect or to believe that prices will reflect fundamental economic value. So some of you might be asking at this point, James, why do you keep on emphasizing that such a high percentage of trading and investing in the market is completely insensitive to fundamental economic value. What does this have to do with flash crashes? Because the topic of this video, as stated in the title, is the fact that the US market has become extremely more vulnerable to a flash crash as a result of these various developments in market structure. And I'm going to explain why it is that the fact that only about 10% of traded volume in the markets is being traded by value-sensitive investors really increases the probability of a flash crash. So this is the point in the video where it's really critical that you understand some basics about price formation in the stock market and price discovery. Now, I'm going to have to make a completely separate video, which I'm going to be putting up in the next few weeks, that really goes into the basics and into the fundamentals of price formation and price discovery. So I'm only going to review a few of these concepts, just enough so that you can understand the content of this video. Now, when we are looking at the behavior of these value-insensitive traders and investors, one of the things that we have to understand is that when prices fall significantly for whatever reason, it can be triggered by a fundamental event or piece of news, or it can simply be something that's completely technical in nature. Almost the entirety of this constituency of value-insensitive traders and investors abandon the field on the buy side of the market. So if we're looking at the traders, certainly the momentum strategies, which actually dominate those traders, they are no longer buyers. They are only sellers. They are selling their positions, and they're actually becoming short sellers. All of the other strategies, they're stopping out of their positions. Even if they're not reversing and going short, they're stopping out of their positions, so they are sellers. Now, what's happening to the passive investors? Well, there's some passive investors that invest in passively managed funds that might panic. So they'll sell, and the managers of these passively managed funds and ETFs, they will end up having to sell shares in order to raise cash. Now, I'm not going to get into the specifics of how the differences between ETFs, but the bottom line is that you'll just have to trust me for now. Those managers are forced to sell whenever their customers panic a little bit. Now, it's true that investors that invest in passively managed funds and ETFs and so forth, it's not like the majority of them panic and sell. It's only a limited percentage, but still that limited amount creates a lot of sell pressure in the market in the short term. But more importantly, there's very little buying going on, because the type of investors that invest in passive strategies don't tend to have a lot of cash on hand. Their whole philosophy is based on being fully invested at all times. So when the market falls, they tend to have very, very little cash to invest. So the funds get very little inflows and they get relatively more outflows. So they become net sellers. So basically in this in this passive investing constituency, you're going to have some net selling, and you're going to have the majority of them that are simply sitting there passive, but they're certainly not buying. So they've abandoned the field. They're not buying. The traders are not buying. So when you get the momentum traders, when you get options traders and market makers that start to sell their positions and start to liquidate positions, who's going to be on the other side of that trade to buy their shares? It's going to be the value-sensitive, fundamentally driven investors. But here's the thing. If valuations have risen significantly, then the reservation prices of the value-sensitive investors are going to be way below what the most recent transaction in the market was before the market started to fall. In other words, if you get a pretty big influx of supply into the market, there's going to be very little demand on the part of value-sensitive investors. And so their reservation prices are way, way below the market price. And since these sellers are completely value insensitive, they're going to have to sell at whatever price they can get. And they're going to hit the bid. And if the bid happens to be 30 or 40 or 50% lower, they don't care. Their mandate obligates them to sell at whatever price. At whatever price there happens to be a bid, they have to sell. And so this is what happens, is that there's a tendency, for reasons I'm going to have to get into in another video, because this video has already gotten too long, but you can already kind of see the outlines of it from this video. There's a tendency as a result of this phenomenon of value insensitive trading and investing for valuations to get out of control, to get too high, to get too expensive. So what that means is that that small constituency of value investors that still trade and invest in the market, they're there, but they're there to buy only when prices are a heck of a lot lower. And so that means that when you have a lot of sellers here, value insensitive sellers, they're going to sell shares, and there's going to be some value sensitive buyers that might buy it a little bit below whatever the current market price was. And then there's going to be another seller here, and he's going to have to sell it at a value sensitive buyer that has a little bit lower reservation price. And we're going to go through the entire supply of shares that are being sold, and one by one, we're going to go down the slope of reservation prices of the potential buyers of these shares. Because remember, the passive investors and the technical traders, they don't care if the stock is getting cheap. The only people that care that the stock is getting cheap are the value sensitive investors, and their reservations prices are well below the market price. And that's where we get the probability or the possibility of a major crash. Because essentially what we have is an air pocket of demand. There is simply no demand between what the current market price is and the bulk of value sensitive demand. The bulk of value sensitive demand is 20, 30, 40% below the market price. And so if there's a significant volume of shares that are to be sold, they're going to have to hit the bid 20, 30, 40% lower. That's the gist of it. That's the key for you to understand why it is the case that the fact that we have moved in such a short period of time to a market that was dominated by value-sensitive investors to a market that's dominated by value-insensitive investors. In the type of market that we have today, that's dominated by by value-insensitive investors, we have vastly increased the probabilities of a flash crash whereby we get into this air pocket where there's just not enough demand to absorb the shares being sold by market-insensitive sellers. And that's where we get the flash crash. So let's review briefly to kind of summarize where we're at this point. Now, roughly 50% of all shareholders of all stocks in the United States are value insensitive. They simply own the shares for other reasons other than economic fundamental value. They bought the stock for reasons other than fundamental economic value. They'll sell it for reasons other than fundamental economic value. But even more importantly, 90% of all daily trades are dominated by value insensitive traders and investors. So we have an overwhelming amount of traders and investors that are value insensitive. Now, when those value insensitive traders and investors abandon the field in terms of being buyers, when they are no longer buyers and they're net sellers, then you have to ask, who are they going to be selling to? Who's going to buy the shares that they're going to be offering? And remember, when they sell shares, they sell it. They're price insensitive. They don't care at what price they're going to sell it at. They simply hit the bid wherever it happens to be. What happens is that the potential buyers out there are value sensitive investors who have reservation prices that are substantially below the market price before you started getting into the crash. And so you hit this air pocket where you have a whole bunch of people that want to sell, and you don't have any value sensitive investors that want to buy right below the market price. They have to hit the bid way below the pre-crash market price in order to get rid of their shares. That is the cause of the flash crash. Now, let me try to illustrate the dynamics of a flash crash by explaining it through an example of price formation. So let's imagine that we have a bunch of value-insensitive sellers that need to sell 100,000 shares of stock. Now, we need to clear the market. In other words, by clearing the market, we mean that we need to find buyers that are willing to clear out that 100,000 shares of inventory. Now, the buyers, as I explained earlier, are value-sensitive buyers. Now, to get enough buyers that are going to buy 100,000 shares, the opinions of those value-sensitive investors regarding what the fair price or the fair value is of the shares of that stock, it's going to be a range, right? Some of those investors are going to think that the fair value or that the fundamental economic value is just below whatever the market price recently was. And some of them are actually going to think that the price is significantly lower. But here's the key. The price that's going to emerge from this particular situation is going to reflect the lowest price, the lowest reservation price of the investors that form this group of investors that are going to buy up this 100,000 shares. In other words, in this group of investors that will be buying the $100,000 shares, it's going to be the opinion of the one who has or that assigns the lowest value. It's going to be the least optimistic of those that's going to actually set the price. In other words, the market price is going to crash down to the price of this more pessimistic investor or this investor that has a lower valuation of these shares. So that's very important that you understand, which is that when you have a fairly large supply of shares and they're going to be sold to value-sensitive investors, you're going to have to hit the bid of an investor who has a reservation price that is very significantly below the most recent market price. Now, it's important to understand that this analysis in no way, shape, or form enables you to predict the date of a flash crash. We don't know when that flash crash is going to happen or what's going to trigger it. More than likely, it's going to be triggered by some sort of fundamental news that causes some selling, and for us to get into that air pocket that I described where we don't have any buyers and where we're going to have enough supply coming from value-insensitive sellers that are going to be hitting the bids way lower. More than likely, that process is going to be triggered by some sort of fundamental news. But there have been a few cases in market history where we've had this type of dynamic happen even without much fundamental news. We had it in 1962, we had it in 87, and we had it in 2010. So it's actually possible that on any given Thursday, we could actually get a flash crash because of these issues that I've pointed out to you in market structure. Market structure right now is ripe for a flash crash, but certainly if we get some sort of a fundamental catalyst, I do think that it's quite likely that we could get a flash crash. And in my other videos, I have two very detailed videos on why we might get exactly that type of fundamental catalyst. And the fundamental catalyst would be an oil price shock. Oil price shocks have historically triggered recessions, and they've historically triggered bear markets. And in this particular type of market that we're in right now, where we're so vulnerable to a market crash, flash crash, due to these issues in market structure, a major spike in oil prices could trigger a big-time flash crash in the stock market. Now, I want you to hit that subscribe button because in the weeks ahead, I'm going to be posting a series of videos that deal with this issue of price formation and price discovery. What I have found is that very, very few people understand this issue and the concept surrounding this issue, even to the point where I can say that 99% of market professionals do not understand how prices are formed in the stock market. They don't understand price discovery. And so for those of you who have been my followers for many years, to those of you who are my subscribers, I'm going to embark on a sort of educational mission, so to speak, to really try to understand, try to explain to you, to help you understand how price formation works in the stock market. This will make you a much better investor, and it'll also help you really understand much better what it is that happens in the market, why prices move the way they do, why markets behave the way they do. You can't understand this through the types of things that you were taught in your finance class in college or in business school, or even through conventional types of theories or teachings that we get in financial markets, such as Ben Graham's School of Value Investing or Warren Buffett's School of Value Investing. We're not going to learn or understand this through the efficient market hypothesis or through the random walk or through the capital asset pricing model. None of these things really teach us or help us to understand how price formation actually works, how price discovery works in the market. This is a very specialized area of knowledge that isn't covered in colleges or universities. It's not covered in financial education or investing education. And I'm going to take it upon myself to produce a series of videos in the next few weeks, months, and even years, where I'm going to talk in great detail about this process of price formation and price discovery. So subscribe to my channel, and I promise you that just the education that you're going to get on this issue of price formation will be very much worth your subscription. Thank you very much.